Hello, I'm Tony Marino, President and CEO of Tenaz Energy. Thank you for joining us for a discussion of our Q3 2024 results. Before we get started, please note our advisory on forward-looking statements. Let's start with a review of our operating and financial results. This quarter's production was up slightly over Q2 and up a little bit more, 7% over Q3-23. Drivers for this in the quarter-over-quarter comparison, higher production in the Netherlands due to lower downtime. And if you look at the year-over-year comparison, in this year's third quarter, we benefited from some successful drilling that we did in the REX in the latter part of 2023. FFO during Q3-24 was down from both Q2-24 and from Q3-23. Driver of this for both comparisons was higher G&A and transaction costs that we recorded for our M&A strategy. That included costs for the NOBV transaction that we announced this summer. In addition, in the comparison to Q2-24, we had the benefit in that second quarter of a prior period income tax recovery. Of course, this same benefit did not exist in Q3-24, leading to a substantial part of that FFO reduction. At the end of this quarter, Q3-24, we had positive net working capital of $9 million. This was down from the levels that we had at the end of Q2 of this year and at the end of Q3 last year. Main driver for this is the deposit that we placed on the acquisition, substantial deposit of about $34 million. In addition, we did incur costs for the transaction expenses that I mentioned earlier, including for the NOBV acquisition. In the case of the year-over-year comparison, we also had the acquisition of the Watlet plant, which we recorded in Q2 of this year. Still a sizable net working capital position at the end of the quarter, even after making those acquisitions, recording the transaction costs, and also placing that deposit for the NOBV acquisition. With respect to TSR, it's been a successful year to date. We're very gratified by and honored by the performance that we've had this year. 189% return, all capital appreciation. This places top of 57 companies that are TSX listed oil and gas companies, a count of 57 that is, at the beginning of this year. And with respect to all 1,800 TSX listed issues in all of the sectors, that total return would place us in the top 1% of the TSX market. Next, let's discuss our 2024 CapEx. We've changed around our drilling program in Canada. Originally, we were going to drill 4 gross, 3.5 net REX wells. These would have been single laterals with multi-stage fracs. Instead, we shifted to a smaller program, a less capital-intensive program, involving 2 gross, 1.75 net wells in the Ellerslie Formation. These are multilateral wells. They're not stimulated, and they're cheaper than the wells that we would have drilled in the REX, but they're still very, very productive. In fact, we can generate almost as much deliverability out of the 2 Ellerslie wells as we could out of the 4 REXs. This Ellerslie pool is one that we acquired along with Watlet gas plant. In that transaction, we got some leasehold that surrounded the plant and a few other tracts of land in the general area. We've identified drilling in several different zones on this acquired leasehold, including the Glauconite, the REX, and in the Ellerslie formations. The main reason for making that deal was to acquire the Watlet plant, but we were fortunate to also pick up this leasehold where we could do this additional drilling. This first Ellerslie well was actually a pretty ambitious well. It has 3 horizontal laterals that are available for production, occurring at a TVD, pretty shallow, of about 1,500 meters. Quite a long well overall, total measured depth of nearly 4,200 meters if you consider the horizontal laterals, and with a total open hole length approaching 2,500 meters in the Ellerslie and penetrating some very high quality reservoir. It's a quite productive well. In the first 45 days of production, it averaged 355 BOED gross at our 87.5% working interest, that's about 310 BOED net to Tenaz. It's highly desirable that the Ellerslie produces at a very high oil percentage. Of that equivalent rate of 355 BOED, 93% of it is oil. It is a medium gravity oil at 26 API, not a heavy oil like from the Rex, less gassy as well. So it's kind of a higher quality production, I would say, than we would get out of the Rex. Well was quite productive, and so we have drilled a second well, a follow-up well, after seeing that initial productivity. We'll give details about this well when we make our next quarterly release. We would expect it to be on production during the fourth quarter of 24. So this Ellerslie program is quite capital efficient with well costs that are under 3 million Canadian, drill complete equip tie. That's the reason that we were able to make this shift to a more capital efficient program for more expensive Rex wells replaced by two less expensive unfracked Ellerslie multilaterals. As a result of this, we've been able to reduce the guidance range for our drilling and development capex, our D&D capex, by about $7 million. It's about a 30% reduction. At the same time, we've maintained our production guidance range. We will probably be closer to the lower end of the production guidance range, in part because the Ellerslie wells, although they have very strong oil productivity, aren't quite as gassy, so the equivalent production is a little bit lower, and there's a significant timing effect. We didn't have that leasehold until the middle of the year. It took a while to the well planned and the equipment moved in to drill it. We wanted to see the results before we drilled a second well. All these reasons gave us a later in the year program than we had planned originally for the Rex, and as a result, we get less annual average production in 2024 out of the program. But still, again, very strong productivities at less capex. I'll point out that those Rex locations are still highly economic, although not quite as economic as the Ellerslie wells that we have drilled, or at least the first Ellerslie well that is currently on production. And we would maintain those Rex wells in our inventory, and we fully expect to drill them in the future. The guidance result is shown on the right side of the slide. The production guidance range the same, 2,700 to 2,900 BOED average for this year. That's a combination of Canada and Netherlands. D&D capex reduced from a range of 23 to 25 million down to a range of 16 to 18 million dollars. We're seeking to improve capital efficiency wherever we can, and even though we had a very good program planned in the Rex, acquiring this Ellerslie leasehold gave us a chance to attempt to generate a more capital efficient program. First well on production, second well expected to be on, and I think we'll have achieved that improvement in capital efficiency that we are always striving for. One of the most important things that we've announced, an event that occurred subsequent to the end of Q3, a placement of a high-yield senior unsecured notes issue, very important step in the progress of Tenaz. So the details of the notes are shown on slide 7. This is a $140 million 5-year issue that we have placed with institutional investors. It is priced at par with a 12% interest rate. It is non-call 2.5, after which, with a premium, decreasing premium over time, we'll be able to call those notes. We expect this note issue to close on November 14th. We have terms in the notes that we think are typical for public issues in the Canadian high-yield market. This notes issue will replace the $90 million delayed draw term loan that we had arranged with National Bank of Canada, this to fund the closing of the NOBV acquisition. So we no longer need that delayed draw term loan. We still have the revolving credit line from National Bank that was already that is currently in place of $20 million. The advantages of this notes issue we think are quite important. It gives us, first of all, the ability to close the NOBV transaction with long-term financing rather than just a 1-year delayed draw term loan. It gives us additional liquidity to help with our international M&A strategy. It's actually quite attractive in interest rate, and I think on all-in cost with the fees associated with these issues, it's actually less than the delayed draw term loan. And I think for the long term, it gets us established in the high yield market. If the company continues to grow as we want to do in our acquisition strategy, pursuing these value adding deals, I think that we have the potential over the longer term to make additional issues in the high yield market. Could be in Canada, it could be in other jurisdictions, but in general, this is a very attractive form of long-term finance, and it's something that to reach the the market scale that we think is ultimately optimal for Tenaz, something going to want to have available. So we're very, very happy about this senior unsecured notes issue. Next, let me briefly update you on the NAM acquisition. Not a great deal to say about this here. During the quarter, on August 5, we did get clearance from the Netherlands Authority for Consumers and Markets for the transaction. This is essentially market concentration approval that we received from the authority. Our transition activities are proceeding as planned, targeting close of mid-2025. We would close earlier if it's possible. We pursue the wide range of operational readiness, HR, IT, and other activities that we have to get done to be ready for the closing, again projected at mid-year 25, but sooner if we are able to achieve it. And just a reminder that the free cash flow that we generate from the assets between the effective date of January 1 and the closing date is going to be reflected in a reduction of the purchase price once that closing occurs. And finally today, just a reminder about our strategy that we are pursuing in Tenaz. We are pursuing acquisitions of conventional and semi-conventional producing assets, both oil and gas, in international jurisdictions. Main regions that we're pursuing the strategy in are Europe and Latin America, some optionality for Canada. I'd say optionality as well for MENA. We think that this is an attractive set of regions to pursue our strategy in, especially as compared to North America. We find it less competitive, getting better rates of return and metrics, multiples on the acquisition initially. We think there's a greater opportunity for operational improvements after we close and become the operator of these assets. And the combination of those two things, we believe, can give us higher returns on capital than we could find in the North American market. So that concludes our review of our Q3-24 results. We thank you for your interest in Tenaz, and we look forward to speaking with you again at the time we release our Q4-24 and year-end 24 results. Thank you.